do. And if you use it in your personal life, as I imagine many of us have, you can see the prospects for productivity. I think it makes people who use it more productive. It may make other people have to find other jobs, though. So it could have productivity implications while also having, social and labor market implications that we don't have the tools to deal with. But yes, I think we're definitely seeing higher productivity. I think it's a little quick to be saying it's generative AI, but I don't know. The pandemic may have induced people to do more automation and do more things with computers to replace people, and that raises productivity, output per hour.
Does that imply a higher neutral rate, and therefore the policy might be a little easier than it seems?
All things equal, yes, but all things aren't equal. There are many things pushing in different directions on where the neutral rate would be. But yes, that argument does come up.
Talking about supply, we have seen major American employers like Amazon cite AI in job cuts. How much right now are you factoring in AI into the current weakness in the job market?
So it's probably part of the story. It's not a big part of the story yet. We don't know whether it will be. But, for example, if you look at, you can't miss the big announcements of layoffs and also companies saying that they're not going to hire anybody for a long time, and they cite AI. That's all clearly happening. At the same time, people are not filing for unemployment insurance. And since job creation, job finding rates are extremely low, if there were big numbers of layoffs, you'd expect the continuing claims to go up, and you expect new claims to go up. It really haven't much. So it's a little bit curious. But longer term, though, the question is, what are we going to see here? And we don't know, but it's it may be that in past technology, really significant technology innovation eras, you have seen some jobs destroyed and other jobs made. Ultimately, what's happened for a couple hundred years is when you get through all that, you have higher productivity and you have new jobs, and there are enough jobs for people. This may be different. It's every time we have a wave of technology, we think, oh, this could put a lot of people out of work. What are they going to do? In the past, there's always been more work and higher productivity, and incomes have risen. What will happen here, we're going to have to see. But right now is such early days. We don't think we see much. It's certainly not showing up in layoffs yet.
And
CP, you have a whole lot of a big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So it is. The implication is obviously higher productivity, and some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time. So it's basically a good thing. But that's certainly the implication.
And just quickly, you mentioned the housing market remains kind of weak. With these rate cuts that we've seen, is there a chance we're going to see more affordability in the housing market so more people can maybe enjoy that part of wealth creation? I mean, the average age or median age of a first-time homebuyer is now 40 years old. That's the highest on record.
Yeah, so the housing market faces some really significant challenges. And I don't know that, a 25 basis point decline in the federal funds rate is going to make much of a difference for people. Housing supply is low. Many people have very, very low rate mortgages from the pandemic period, and they kept refinancing and caught the really low. So it's made expensive for them to move. And, we're a ways away from that changing. Also, we haven't built enough housing in the country for a long time. And so a lot of estimates suggest that we just need more housing of different kinds. So housing is going to be a problem, and really the tools to address it are we can raise and lower interest rates, but we don't really have the tools to address a secular housing shortage, a structural housing shortage. The stance of monetary policy. In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, The committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time. Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement, or repo operations, are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning and should be used when economically sensible. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Fed, we will do everything we can to achieve our maximum employment and price stability goals. We need to keep an ample supply of reserves out there. Why so big? The answer to that is, if you look ahead, you'll see that April 15th is coming up, and our framework is such that we want to have ample reserves even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government, reserves drop sharply and temporarily. So this seasonal buildup that we'll see in the next few months was going to happen anyway. It was going to happen because April 15th is April 15th. There's also a secular ongoing growth of the balance sheet. We have to keep reserves, call it constant, as it relates to the banking system or to the whole economy. And that alone calls for us to increase about $20-25 billion per month. So that's a small part. That's going on. It's also happening in the context of a temporary few-month front loading to get reserves high enough to get through the tax period in mid-April. So that's what's happening there.
90s, the committee did two discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down, or should we think of policy risks as genuinely two-sided from here?
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year. But when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3 is not a big data set, but you are right about those 2 3-cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years, and indeed the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy from the notwithstanding the 150 basis points in cuts prior to today.
So I think the idea is that with now having cut 75 basis points more now, and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths, but we won't see, any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation, and as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation, but we're going to start to see the data, and it'll tell us whether we were right or not.
Welcome to the Crypto Teacher.
Don't forget to like and subscribe to the channel.
And I come back with that video just to make you think. And make sure you're joining the Patrons. If you're not a part of the Patrons, make sure you're hitting the Cash App. Also, go like and follow the TikTok. More videos to come. And we had Jerome Powell in the house. And this was one of his best meetings because he didn't say a whole lot. He just repeated what we already knew. AI is going to be replacing a whole lot of people. And he was asked about AI, asked about housing. The average person is 40 years old buying a home, the highest in history. And what did Powell say? The Fed doesn't have a fix for that. And we know for a fact the central banks caused it all. Printed 80% of all money in existence in 2 years. Yes, you can make this up. And in the history books, people are going to look back and wonder what the heck the people were doing when they were printing all these pieces of paper and buying real resources. You can't make it up. This is worse than Babylon. We're going to go down as the worst civilization in history. And remember, the Crypto Teacher told you. The sheep are worried about things that don't matter. You go ask anybody, what did Jerome Powell say today? And they'll ask you, who is Jerome Powell? You can't make it up. Remember, your life is an illusion and TV is your reality. And Jerome Powell repeated again that they're going to be buying the front end of that yield curve. And why, guys? Because we know Japan is about to start raising rates. And not one of the reporters asked about Japan. That should have been the first question. But they know that Japan is about to move and it's going to send a rumble to this economy, and they're trying to get ready. Remember, they've already ran plenty of simulations on what's going to happen. And that's the reason why they're putting up emergency backstops to try to control this rumble, but at the same time, move over to the 4th Industrial Revolution. And remember, the Crypto Teacher told you. And then, of course, we asked about tariffs, asked about the Supreme Court. And we know Jerome Powell is not going to answer that. But we know there's definitely going to be drama around these tariffs. So get your popcorn, sit back, and let it play out. And remember, the Crypto Teacher told you. Because he knows, when it comes to the NWO, it's all planned out. You have a wonderful day.
We're not legal commentators. It's before the courts, and we think we don't think that we help matters by trying to engage as a public discussion of that. I'll give you a mulligan though.
No, thanks. I don't know if that means I get 3 questions, but
no, just one. Just one more.
I guess I wanted to come back to the 1990s question, and like, do you see that as a useful model for thinking about what is happening in the economy right now?
I don't think it rises to that level. So I did think that in 2019, where we cut 3 times, but this is such a unique situation. It's not the 1970s, let's put it that way, but we do have tension between our 2 goals. And so that's just unique in my time at the Fed, and I think going back a long ways, we haven't had that. In our framework, as you know, says that when that's the case, that we try to take a balanced approach to to the two things, and we look at how far they are and how long it would take to get them back to each of them back to the goal. And that's a very subjective analysis, really. But it just tells you you've got to, and I think ultimately what it says is when they're broadly equally threatened or equally at risk, you should be kind of neutral. Because if you're either accommodative or tight, you're favoring one or the other goal. And so we've been sort of moving in the direction of neutral. Now we're in the range of neutral. We're in the high end of the range of neutral, I would say, and that's what we're doing now. It so happened that we've cut 3 times. That we haven't made any decision about January, but as I've said, we think we're well positioned to wait and see how the economy performs. There's the announcement of a tariff, and then they start to take effect, and then it takes some months. Goods may have to be shipped from other parts of the. It may take quite a while for an individual tariff to take its full effect. But once it's had that effect, then the question is, isn't that just a one-time price increase? So we actually look at it, all of the announcements and what you get from all that. You see sort of for each one of them, there's a time period, and then it's fully in. So if there are no new tariff announcements, and we don't know that, but let's assume there are no major new tariff announcements, inflation from goods should peak in the first quarter or so, right, or roughly. We haven't been able to predict this with any precision. No one is. But call it the first quarter or so of next year should be the peak. And from here, it shouldn't be big. It should be a couple tenths or even less than that. We don't really have precision on this. And after that, again, if there are no new tariffs that are being announced that will take 9 months to get fully in, and 9 months is also an estimate, then you should start to see that coming down in the back half of next year.
And I want to see if I could address sort of the elephant in the room. The president's been talking openly about a new Fed chairman. Does that hinder your current job right now or change your thinking at all?
No.
Okay, and just to follow up, please, given your growth upgrade, how would you factor in, or what would be the economic impact if the Supreme Court is to strike down the tariffs that they're currently hearing, please, in terms of growth and inflation? Thank you.
I really don't know. It would depend. It would depend on a whole bunch of things we don't know. So I can't really help you there.
Are 50 basis points higher than when you started cutting back in September of 2024, and the yield curve basically has been steepening. Why do you think that continuing to cut now, especially in the absence of data, is going to bring down the yield on the thing that will move the economy the most?
So we're looking at the real economy and focusing on that. And you've got it when the long bonds move around, you've got to look at why they're moving around. If you look at inflation compensation, it's very that's one part of it is inflation compensation break evens, and they're at very comfortable levels. They're at levels consistent once you get out past the very short term now. Break evens are at at quite levels that are quite consistent with 2% inflation over time. So there's nothing happening with rates going up out there that suggests concern about inflation in the long term or anything like that. I mean, I look at these things pretty regularly. Same thing with surveys. Surveys are all saying that the public understands our commitment to 2% and expects us to get back there. So why are rates going up? It has to be something else. It must be an expectation of higher growth or something like that. And that's a lot of what's been going on. I mean, you saw a big move, toward the end of last year, which was not to do with us. It was to do with other developments.
Well, you just mentioned that the public is expecting you to get back to 2%, and Americans overwhelmingly are citing high prices, inflation, as their number one concern. Can you explain to them why you're prioritizing the labor market, which seems relatively stable to most people, instead of their number one concern, inflation?
So we, as you know, we have a network of contacts in the U.S. economy, which is really unmatched if you go through the 12 reserve banks. So we hear loud and clear how people are experiencing really costs. It's really high costs. And a lot of that is not the current rate of inflation. A lot of that is just embedded higher cost due to higher inflation in 2022 and 23. So that's what's going on. And so the best thing we can do is restore inflation to its 2% goal. And Our policy is intended to do that, but also have a strong economy where real wages are going up, where people are getting jobs and earning money, and we're going to need to have some years where real compensation is higher. It's positive, significantly positive. So nominal wages are higher than inflation, for people to start feeling good about the affordability issue. And so we're working hard on that. We're trying to keep inflation under control, but also support the labor market and strong wages, so that people are earning enough money and feeling economically healthy again. And inflation remains somewhat elevated. In support of our goals, in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by 0.25 percentage point. As a separate matter, we also decided to initiate purchases of shorter-term Treasury securities solely for the purpose of maintaining an ample supply of reserves over time, thus supporting effective control of our policy rate. I will have more to say about monetary policy and its implementation after briefly reviewing economic developments. Although some key government data have yet to be released, available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. In contrast, activity in the housing sector remains weak. The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter, but these effects should be mostly offset by higher growth next quarter, reflecting the reopening. In our summary of economic projections, the median participant projects that real GDP will rise 1.7% this year and 2.3% next year, somewhat stronger than projected in September. In the labor market, although official employment data for October and November are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. The official report on the labor market for September, the most recent release, showed that the unemployment rate continued to edge up, reaching 4.4%, and that job gains had slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by